Everyone, welcome. If you're looking to actually understand what's happening beneath the surface of the currency markets, well, you're in exactly the right place. In this explainer, we are going to completely demystify 8 essential terms you absolutely need to know before you even think about placing your first trade. And we're not just reading dictionary definitions here. We're going to see how these fundamental building blocks literally dictate your strategy, your mindset, and ultimately whether you win or lose in the market.
Okay, let's dive into this. Here is our roadmap for today. We're covering price movements and spreads, trade sizing and lots, the power of leverage, margin and account safety, and finally, mastering risk management. Let's kick things off with price movements and spreads. So before you can make a single cent of profit, you really have to understand the micro mechanics of how a price is quoted and the immediate cost you're going to face the very second you enter the market. Whenever you look at a currency pair, you're always going to see 2 prices. The bid price, which is where you can sell, and the ask price, which is where you can buy. That gap between the two, that's called the spread. Basically, think of the spread as the broker's fee. It's their cut for facilitating your trade. Let's look at how this plays out in the real world. Say you're looking at the euro to US dollar pair, and it's showing a bid price of 1.1000 and an ask price of 1.1002. That means the spread is exactly 2 pips. Now, this right here is exactly why, the moment you click buy, your screen instantly flashes red. Because of that spread, every single new trade starts off with a tiny unrealized loss. Your trade actually has to move in your favor just to cover that initial broker cost before you can even think about being profitable. Now, I just threw the word pip out there, so let's break down what that actually means. Pip stands for percentage in point. Once you've paid that initial spread cost, the pip is just the standard unit of measurement we use to track how much the market is actually moving. It's literally just how we measure distance in the Forex world. For most currency pairs, 1 pip is equal to 0.0001. So, if the euro to US dollar goes from 1.1000 up to 1.1005, well, that's a movement of 5 pips. Now, there is one major exception you've got to remember, and that's Japanese yen pairs. For those, 1 pip is actually 0.01, and that's just because of the historical way those specific pairs have always been quoted.
Occasionally, you'll be looking at your screen and you'll spot a price with an extra 5th decimal place, something like 1.10005. That tiny little number at the end is called a pipette. It's just a fractional measurement, literally 1/10 of a pip. You can kind of think of pipettes as the pennies of the Forex world. Brokers use them to give you pinpoint precision. But honestly, as a beginner, don't let it distract you. You're going to be calculating your actual wins and losses in standard pips.
Moving right along to trade sizing and lots. Okay, so once you know how far the market is moving, the next big thing that determines your outcome is how large your position actually is. Instead of traders constantly running around saying, hey, I want to buy 100,000 units, the market uses what we call lots. There are 4 standard tiers here, giving us a really clear scale. A standard lot is 100,000 units. A mini lot is 10,000. A micro lot is 1,000, and a nano lot, which some brokers offer, is just 100 units. It's a pretty straightforward concept. The larger your lot size, the larger your potential profit, but absolutely the larger your potential loss too. To really hammer this home, let's contrast 2 hypothetical traders. Let's say both traders analyze the market and make the exact same trade, and the price moves exactly 20 pips in their favor. Great. But Trader A used a standard lot and Trader B used a micro lot. Even though the market moved the exact same distance for both of them, Trader A's financial outcome, whether it's a win or a loss, is drastically larger than Trader B's. Your lot size is essentially a direct multiplier for every single pip the market moves.
Next up, we have to talk about the power of leverage.
Now, you might be sitting there wondering, wait, how does a normal, everyday retail trader actually afford a standard lot of 100,000 units? And that brings us to leverage. This is a real game changer. It's the secret weapon that makes retail trading possible in the first place. In simple terms, leverage is borrowed temporary buying power that your broker provides. It lets you step into the market and control a massive trading position using just a relatively tiny amount of your own capital.
Let's put some numbers to this with a super common leverage ratio, 1 to 100. With 1 to 100 leverage, every single dollar in your account gives you the power to control $100 out in the market. Meaning, if you have just $100 of your own money, you can instantly control a $10,000 position. It is an absolutely incredible financial superpower for boosting your profit potential.
But we need to pause here for a second and ask a really critical question, because that massive multiplier, Yeah, it works in both directions. So what exactly happens if your highly leveraged trade starts losing money? If you're controlling $10,000 with only $100, a very small drop in price could completely wipe out your initial funds. It's a superpower for sure, but one that can backfire on you fast.
Which brings us to our next crucial topic, margin and account safety.
Because leverage comes with so much inherent risk, brokers have these built-in safety mechanisms to manage what happens when a trade turns against you. But first, let's clear up a major friction point I see with beginners all the time: confusing leverage with margin. They work together, absolutely, but they are not the same thing. Leverage is the buying power the broker gives to you. Margin is the requirement the broker takes from you.
So, what is margin? Margin is simply your own money, set aside as a security deposit just to keep a leveraged trade open. And I really want to be reassuring here because people get worried. Margin is not a transaction fee. It's not money you've lost, it's just locked or reserved while your trade is active. The exact second you close that trade, your margin is fully released back into your available account balance, assuming, of course, that your trading losses haven't eaten into it.
But what happens if those losses do start eating into it? Well, it sets off a cascading domino effect, and it's important you know how this works. Step 1. Your open trades start losing value, which directly chips away at your available account balance. If the market keeps moving fast against you, we hit Step 2, the margin call. And if things get really dire really quickly, we hit Step 3, the stop out.
Let's look at that warning face. A margin call is basically a flashing red light on your dashboard. It's a formal, urgent warning from your broker saying, hey, your account balance has dropped to a critical level and you don't have enough funds to safely support your open trades anymore. When you get a margin call, you've got to take immediate action. You either need to close out your losing positions to free up margin, or you have to deposit more funds into your account right then and there.
Now, if you just ignore that margin call and the market keeps dropping, the broker is going to step in with their final safety mechanism, the stop out. A stop out is an automatic process where the broker forcibly closes some or all of your losing positions. Honestly, it is a really painful lesson to learn, watching your trades get closed against your will. But it's actually a necessary safety net. It strictly prevents you from owing the broker money and makes sure your account balance doesn't go negative.
Finally, let's move on to mastering risk management.
So, you've seen the mechanics of how trades happen and how accounts can be rapidly drained. Now, let's talk about how the pros actually avoid those account disasters. Professional traders know that staying in the market long-term has absolutely zero to do with luck. It's all about structured discipline. They survive by following a strict checklist. They use appropriate lot sizes. They fiercely avoid the temptation of maxing out their leverage. They always, and I mean always, set stop-loss orders so a bad trade exits automatically before it turns into a total disaster. They strictly limit how much capital they'll risk on any single setup, and they constantly make sure they have plenty of free margin buffering their account.
So let's bring this all together. The whole shebang intrinsically interlocks. The market moves in pips. Your lot size dictates exactly how much each of those pips is worth. Leverage is what empowers you to control those large lots in the first place. And margin, that's the security deposit holding it all together. When you combine pips, lots, leverage, and margin, they equal the exact formula for your total risk and reward on every single trade you take.
We've covered the essential building blocks today. You now have a stronger foundational understanding of these mechanics than most beginners who just jump in and blindly click buy or sell. So I want to leave you with this provocative thought to chew on before you analyze your next chart. Now that you actually know the mechanics, are you actively managing your risk using these tools, or are you just hoping the market moves your way? Apply these concepts, respect the mechanics, and trade smart.